I don't think the Fed has anything to do with what we call inflation. It's oil prices and used car prices that were triggered by the base effects of shutting an economy down, then turning it back on. And look, CPI perfectly correlated 16 months after M2 growth. M2 growth went negative for the first time in, I think, 96 years. Let that one sink in. It's been 96 years of constant money printing since the Fed was created to diminish the value of the currency, to steal wealth from the masses and give it to the people at the top, which, right, income and wealth inequality is where it is. So mission accomplished by the Fed.
The economic and market turbulence of 2022 might be a small hint of what is to come in the next decade for the U.S. economy and stock market. Several top investors and analysts have shared views that inflation might not be the biggest threat to the stability and growth of the U.S. economy in the coming years. In the latest episode of the On the Margin Weekly Roundup with Blockworks macro popular hedge fund Mark Yusko joined the crowd of top investors that have predicted at least a decade of slow or no economic growth for the world's biggest economy. During the podcast, Yusko explained that the labor market and the false economic growth recorded during the fourth quarter of 2022 are the only things keeping the economy from a recession. But both are about to go in the other direction, according to the Morgan Creek Capital founder and managing director. Yusko pointed out that despite the Fed's constant manipulation of data, the unemployment rate is about to shoot skyward, especially with the tens of thousands of job cuts that have been announced in the past week. The veteran investor also expects negative GDP growth in the first quarter of 2023, which together with an increase in unemployment will finally force policymakers to admit that there might be no soft landing for the economy. Yusko also pointed out that no catalyst currently points out a possible recovery in the stock market, at least not for the rest of the decade. Before we listen to Mark Yusko's interview, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Also, ensure you drop your comments and observations on Yusko's interview in the comments section below. Everything you do helps with the YouTube algorithm, so we can continue to bring you these videos. Thanks and enjoy the video.
But the challenge now is, again, I don't know, all of this is literally nonsense in that there is no pricing power for employees. How many announcements of 10,000 workers being laid off have you heard in the past month? Every single day, another company is laying people off. Our company, for the first time in 20 years, we had to let some people go. It just never, we never got to that point before. This has been, and this idea that, unemployment rate is so low. Well, no, it's not. It's because you're fudging the numbers. Again, the massive engineering, right, by taking people out of the labor force, making the labor force seem smaller, so the percentage of unemployment, those people are still working. But just because they turn 65 doesn't make them out of the work, but that's the way they do it. And the birth-death ratio nonsense. So I hear the narrative that people have crafted, and I hear the torturing of the data, right? If you torture the data long enough, it will confess. The torturing of the data continues, but you go around and you look at economic activity, which is the true measure of whether wages are good or not good, or economic activity, it's not so good. In fact, some of it is downright abysmal, like plumbing levels we haven't seen since global financial crisis or the Great Recession or the period, the tech wreck. Look, from 1968 to 1982, the economy went precisely nowhere. We had multiple recessions, multiple recoveries, and quote unquote these soft landings. Because I guess if you fall from a really low level, it's softer than if you fall from a really high level. So the fact is you never took off, you didn't crash. So I guess that's one way to look at it. But from 68 to 82, stock market was precisely 1,000 points. The Dow Jones Industrial Average was 1,000 points for 14 years. And yes, it went up and went down, and there were big drawdowns and big recoveries. And there's another bull market. Dead flat for 14 years. Great. That's where I think we probably are. I think we're going to have a lost couple decades of basically no economic growth, kind of like Japan's had for the last 3 decades. Stock market probably does this, right? I made the bet with Kevin O'Leary on CNBC 4 years ago that Amazon would be dead money for a decade, and so far I'm winning. And I don't. Again, I'm not gloating in the fact it's not that Amazon's not a good company; it's a great company, but they just reported the largest loss in their history. Apple was bad. Amazon was bad. Shoot, I can't remember the other two. But all 4 of them, bad. And on top of that, that's on top of Microsoft was bad. Netflix was bad. Even Meta was bad, right? They missed on revenue. The revenue growth is turning down. Apple's, which just went negative. So those are not growth companies.
As Mark Yusko has explained, the Federal Reserve is quite fixated on the labor markets because it is the last straw that could make or break their narrative. During his last press conference, Fed Chair Jay Powell gave the markets some mixed signals, which many translated as dovish. Experts have also pointed out that Powell seems to be handing the markets a small bone to alleviate the effects of last year's aggressive rate hikes. In the same vein, the central bank is also paying close attention to the labor market and wage gains. Officials believe strong wage gains could further fuel inflation and make it more difficult to get prices under control. But with the tens of thousands of job cuts announced in the past months, the central bank might be far off the mark about the perceived growth in the labor market. Let's get back to Yusko's interview as he discusses his views on the January effect rally and the issue of liquidity in the US, Europe, and Japan.
Look, there's no question Q4, fourth quarter, massive government spending, big inventory build. And Powell did say, right, don't expect those 2 things to continue, right? So he was kind of warning that Q1 GDP is going to be not so great. But if you look at Q4, 75% of the growth, it wasn't really growth, was this draining of the TGA, government spending, and building up inventories. Now, look, we did talk about this a few weeks ago, saying that the amount of tax loss selling that occurred in 2022 did set the stage for the potential for this January effect. Now, I didn't think it was going to be this crazy. Where you had stocks going up 30% every day, and companies like Bed Bath and Beyond, I mean, bankrupt, like liquidating, gonna go away, and people are still punting in that stock. So good for them. Musical chairs, it's not a game I like to play. But here's the thing that I just don't understand is the Fed is not adding liquidity. They're just not, right? They're simply not. The ECB, not. See, the ECB is now in the hot seat. Ms. Christina, she's got a problem. She is now the one that has to raise. She's 200 basis points behind everybody else. That's going to be a tough one for Europe. Now, the European banks love it, and the European banks are going, bananas. But rest of Europe, they don't like that very much, particularly the exporters, because it's going to strengthen the euro, and dollars continue to fall. Euro is going to strengthen. The yen is the wild card. I mean, Kuroda-san unleashing this Kuroda tsunami, that should actually weaken the yen pretty badly, which maybe the dollar stays flattish. But the euro probably going to rise a lot, and it's going to be tough to sell, Volkswagens and Audis if your currency's strengthening. So I think Europe's going to struggle from an economic growth perspective. In fact, I think Germany just went negative in Q4, like 0.2 or something like that. Economically, I get why Jay Powell is saying, don't count on the government spending to continue, because we're almost out of money, and they're certainly not going to increase taxes, because that's not a popular platform to run on. I still come back to PMIs are rolling over, industrial production is rolling over, new orders component of PMIs are rolling over. I don't see any catalyst for a strong recovery. And if the definition of soft landing is the Chuck Yeager right? Any crash you can walk away from is a good landing. Okay, well, we're not going to crash, but I don't see us getting back in the sky anytime soon.
During the podcast, Yusko added that he would begin to turn less bearish and more bullish on the economy if there were positive changes in the Purchasing Managers' Index, retail sales, industrial production, or Q1 GDP. Even a sustained upward movement in any of these indicators could indicate some considerable strengthening of the economy, but that remains yet to be seen. Yusko's assessment of the stock market aligns with a previous prediction from Gareth Soloway, who believes that the U.S. stock markets might be in for a rough year, necessitating investors to diversify into other assets, especially Bitcoin and other top cryptocurrencies. What are your thoughts on these predictions for the U.S. economy and stock markets? How do you think a sustained decline in stock prices would impact crypto prices within the coming years? Let us know what you think in the comments section below. Also, ensure you like this video, subscribe to the channel, and check out our other videos. Thanks for watching.